In part 2 of chapter 10, we're going to look at cost after we acquire the asset. Up to this point, particularly in part 1, we were looking at all the costs up until we start using the asset. So, all the costs incurred to acquire and get the asset ready for its intended purposes, those are all capitalized as part of the cost of the asset. Even interest, up until the point until we start using the asset, even interest is a part of the cost of the asset. But in this unit, we're going to really look at after we've acquired it and start using it, the cost after that. What do we do with those costs? Well, in accounting, there's really only two ways an accountant will record a cost. Either we capitalize it as an asset, or we capitalize that cost as an expense. Back in chapter 2 of the conceptual framework, the definition of an asset, part of that definition includes this phrase that the cost incurred will provide future economic benefits. And if it does, then we capitalize that cost as an asset. And if it doesn't, then we expense it. So costs incurred just to maintain the asset in its present condition, we expense those. So, and I'll just make a point, on page 560 of your textbook, where it illustrates, how to account for costs subsequent to acquisition. I found that a little bit confusing, so I'm going to encourage you, let's keep it simple. Let's not worry about whether we define the cost as an improvement or a replacement or something like that. Let's just look at the two categories here. If that cost provides future economic benefits, we're going to capitalize it, and if it doesn't, we'll expense it. Now, in order for it to provide future economic benefits, one of these three conditions has to be met. If the cost lengthens the life of the asset, so if we do something to the asset and it's going to extend its useful life, we capitalize it. Now here's the interesting thing. Notice the debit is not to the property, plant, and equipment account, it's to accumulated depreciation. So let's say we had, like a piece of equipment, I'm just going to abbreviate that, for $100,000. And let's say that equipment had accumulated depreciation, let's say 60 grand. So the book value would be $40,000 at this point in time. So let's say that we spend $5,000 on a cost that will extend the useful life. So what's going to happen is that if we debit accumulated depreciation, that's going to change this balance to $55,000. So nothing will happen to the equipment account. It'll stay at $100,000, but accumulated depreciation will shrink if we debit it. And now the book value will be $45,000. So in effect, we're increasing the accounting value by debiting accumulated depreciation. So you can see why debiting accumulated depreciation does increase the accounting value of the asset. Now secondly, why bother with it here? Why take it to accumulated depreciation? Well, the theory is if we've depreciated $60,000 and we're extending the useful life, well, we're going to recover like $5,000 of that prior depreciation and move it forward to the future. So again, the theory is debit accumulated depreciation because we're going to recoup some of that old depreciation we've expensed and move it forward to the future. So that's the idea. Categories number 2 and 3, if it increases production of the asset, so now the asset will produce more units of whatever it is that it produces, or it improves the quality of the asset. So here's some examples of that. If we add a major part to a machine, increasing its efficiency, then we would capitalize that. If we add a room to a building, we would capitalize that. Or add air conditioning to whatever, we would capitalize that. If we replace an old car engine with a new one, we would capitalize that, because all of those increase the future economic benefits. But examples of expenses, replacing small parts, repainting, or typical oil changes, those usually do not have long-term benefits and we expense them. Now the reality is most companies will set a floor. and they'll just have an accounting policy, maybe like something like any cost under $1,000 gets expensed immediately because it's immaterial. So because, so they'll set a floor of, even if it has long-term benefit, if we pay less than $1,000 for it, we'll expense it. So again, the floor might be $100 for a really small company, and it might be, $20,000 for a really large corporation. The other thing I want to point out, and it was in your textbook, and I'm glad they included it, the author did, is that what we've just gone over is really epitomizes what happened at WorldCom. WorldCom had some expenses that some costs that it should have expensed, but it capitalized those. So, it understated expenses on the income statement, and if you understate expenses, right, you're going to overstate your net income. And instead it recorded them as assets. So on the balance sheet, it overstated assets on the balance sheet and it inflated those. So, by doing that, it inflated its balance sheet and it inflated profits. So that was the WorldCom fraud. It's pretty simple. Actually, a simple fraud that probably actually should have been detected. Okay, I'm going to stop the video for now. Go ahead and fill out. Here's 4 illustrations. Write out the journal entry for these. Like on the first one, cash is going to go out. So go ahead and record your cash of $10,000 and then figure out, what's going to be the account debited for 10 grand. So I'm going to stop it, and please stop yours as well and fill it out and then come back. Okay, so on the first one, we can see we would capitalize that because it's increasing the number of units the machine will produce, so we capitalize that. In the second one, again, we're adding something in. So it has a long-term benefit, and we capitalize that cost of $25,000 as well. The third one also gets capitalized, except we debit the accumulated depreciation to decrease accumulated depreciation because it extends the useful life. And then the last one is an expense. Okay, so on exercise 23, I'm not going to go through all of it, but you're just deciding whether to capitalize or expense. And so like for the first one, we'd recognize an improvement's going to have long-term benefit. We would capitalize that. Okay, let's go on to exercise 24. Exercise 24 looks at sales or dispositions of assets, of property, plant, and equipment assets. So basically, here's what we do when we sell or dispose of long-term physical assets. We're going to record the depreciation to date. So we want to update the depreciation expense and accumulated depreciation account. Secondly, then, we record the sale. So we give up the asset, so remove its book value. Cash comes in, and usually those will not equal. The difference is a gain or a loss. So let's look at, what would we do with these 3 scenarios. Okay, so in exercise 24, we're going to record depreciation expense, do step 1, and then also record the cash coming in, get rid of book value, and then the difference is a gain or a loss. So I've already got this set up for us. The other thing I went ahead and set up here is that it tells us in the narrative annual depreciation expense is $60,000. So we're not going to record a full year because each of these A, B, and C take place at a different time. I also went ahead and set up beginning accumulated depreciation is $360,000. So we need to figure out, for this debit to accumulated depreciation, what's going to be the new balance. You are welcome to just hit pause on your video and see if you can go ahead and figure out what these entries would be. I think that probably would be a good idea, so you can see if you can do it by yourself. But otherwise, I'll go ahead and work through them. In situation A, there's a fire that took place on August 31st. So August 31st, at the end of August, that would give us 8 out of 12 months of depreciation. So 60,000 times 8 twelves would be depreciation expense of 40,000. So we would record that in our journal entry. Now that means we're increasing accumulated depreciation by 40,000. So now accumulated depreciation will have a balance of 400,000. So in the second scenario, in the second part of this entry, we're going to get rid of accumulated depreciation. It now has a balance of $400,000. The asset itself, the machine, had a cost of $1,300,000, so we'll credit that. So I've gotten rid of I've taken care of removing book value. Cash came in this case. They got insurance proceeds of $430,000. So, I can software my book value and compare that to cash, and that will give me the gain or loss. Another way is just add up your debits, subtract that from your credits. We need a debit to balance. If we need a debit, that's a loss. And so we need a debit to balance, that would be $470,000. So we kind of plug that in and just make it balance in the journal entry. In scenario B, they actually sold a piece of equipment April 1, so January, February, and March. So 3 out of 12 months would have gone by. That's $15,000 of depreciation expense. Okay, so then accumulated depreciation goes up by $15,000, right? If I post that $15,000. So now accumulated depreciation would have a balance of $375,000. And again, the original cost was $1,300,000. So we remove book value. We sold it for $1,040,000. It tells us in the narrative of the problem. So cash came in, we give up book value, the difference is a gain or loss. I can also just add up my debits, look at the difference with that from the credit. This time I need a credit to balance of $115,000. If it's a credit, it's a gain. So we would have a gain of $115,000. Okay, then on part C, they actually donate equipment on July 31st, so 7 months out of 12 would have gone by because it went all the way through July, not the beginning of July, so 7 months. So we would record depreciation expense of $35,000. So add that to our beginning balance of accumulated depreciation, and that gives us accumulated depreciation of $395,000. And again, we want to get rid of when we donate it, we're going to remove the full book value. So what's in the accounting records at the date of donation? We want to remove the accumulated depreciation and the machine account. Now this time, we didn't get any cash, but we are donating it, and so we're going to have something like some sort of expense account. We'll call it contribution expense. So we'll debit an expense account. I'm just going to call it contribution expense. And I'm going to record that at fair value. The fair value of the asset at the time of the donation in the narrative of the problem, it tells you, is $1,100,000. So again, we're back to, I realize this is an exchange, but we're giving up an asset and reporting it at its fair value. So here again, I take my debits versus my credits. We actually end up with the gain. We need a credit to balance $195,000. Gain, $195,000. Okay. I also wanted to look at, the city that we donated this to, what would their journal entry have been? So they would have a machine coming in, and the city would have recorded it also at its fair value. $1,100,000. So again, fair value would be used by the city, and then they would have something like, contribution. I'm going to get all that written there. Contribution revenue for the $1,100,000. Exercise 22 is just a hodgepodge of different things. I wanted to go over it just to make sure that you were clear on how to work through it. The first two, I already gave, on your student materials, you can see I've already given you the solutions for those. Because in this first one, they've got a building that they're tearing down. That's really just a disposal of an asset. So we want to account for it like that. So notice we get rid, accumulated depreciation and the building account, so we remove book value. In this case, instead of receiving cash, they had to pay some cash, and then the difference of all of that was a gain or a loss. In this case, they needed a debit to balance, so they have a loss. In the second one, they actually have a sale of a piece of machinery. So here again, they remove accumulated depreciation and the machine account, so they're removing book value. Cash comes in, and the difference there is a gain or loss. They needed a debit to balance, so that would be a loss. Okay, so we're going to look at the last three. On March 20, a gear breaks down, costs $9,000. It's replaced at a cost of $2,000. It does not extend the useful life of the machine, but it makes it more efficient. So since it makes it more efficient, we're going to capitalize that cost. So we're going to debit the machine account and credit cash for $2,000. Okay, so we capitalize that particular cost. For the second one, we install a special base. When the machine was purchased, it had a replacement cost of $5,000, but because of defective workmanship, they're having to replace the base. So the cost of the machine was $14,200 in 2008. The cost of the base, though, is only $3,500. So of that $14,200, $3,500 is associated with the base. Okay, so let's go over and kind of look at what's going on. So we want to remove, we're removing the old base, so we want to reduce the machine account for $3,500. That's the portion of the base. We also want to remove accumulated depreciation related to the base. So take that out. Now let's go back, and in the narrative it's going to tell us that that annual depreciation expense is 10%. 6 years have gone by, right? 2008, so 2008, 9, 10, 11, 12, and 13. So 6 years have gone by for depreciation. So 6 times 10%, we're going to get 60%. Now notice, even though we're in 2014, I did not include 2014 because it tells us that they have a policy, no depreciation is charged in the year that the asset is disposed. So they just have an accounting policy. Then the reason they can have that kind of policy is it's really immaterial. 1 year's depreciation is going to be immaterial for the entire income statement. So immateriality. Anyhow, we have 6 years depreciation at 60%. So 3,500 times 60% depreciation would give us an accumulated depreciation of 2,100 that we need to remove. Okay, so we get rid of book value. Now, we also have a new component coming in. So we've got a new gear coming in with a cost of $5,500. And we paid cash for that. So we credit the cash account, $5,500. Okay, and then so essentially we give up book value and cash. We get the new machine, and the difference is a gain or loss. And so we need a debit to balance of $1,400, and we would have a loss on disposal of $1,400. Now, this is how the author recorded this problem. I probably, again, another accountant might think and view this to handle it a little bit different because it was because of a defective part. If it was due to a defective part, perhaps we shouldn't capitalize this new cost. But again, one could debate and argue that. But I do want you to see how to work this. We're really giving up an old for a new. So we're giving up an old part plus cash for new, and the difference is a gain or loss. Okay, and then lastly, a repainting. Again, if it was the original paint with long-term benefit, that would be capitalized costs, but we're repainting. So with the repainting, that's just repairs and maintenance expense. I'm just going to abbreviate that, repairs and maintenance expense. Separate these two, and cash will go out. Exercise 6 it has a variety of things in it, and that's why I assigned it, just so you wouldn't think, okay, this is the this exercise does this exercise covers this. This particular exercise touches a variety of topics, so you have to recognize the situation and apply the rules that for that. So I encourage you to work through this, and then so pause, see if you can work through these, and come back and check your work with what I'm going to do. So on the first one, we have buying, 3 assets, land, building, and equipment, and they're paying $700,000 for it. But what they did is they said, okay, we're going to take these values, like for building, $250,000, and capitalize that. Here's book value that this company had, and we'll just capitalize it at that. And then they plugged the difference to the land account. Well, I hope you recognize that's not the appropriate way to have done this. The appropriate way would have been to allocate based on appraisal values. So let's go take a peek at what that would look like. So we would take the $700,000 cost, and let me go back here real quick. If I add up these appraisal values, you're going to get $800,000. So we're just going to take land is, what percent of that 800, building is what percent, and equipment is what percent. So we can see that's what they're doing here, arriving at those fractions, take the fraction times the cost, and then that's what's going to go into each asset account. On the second one, we have store equipment being purchased with a $2,000 down payment, and then they sign a note for $23,000. But they recorded it as this. They included this interest payable, which doesn't make sense at all, does it? And that interest payable increases our debit to the equipment. So the correct entry would be not to include the interest payable, because we're going to expense the interest after we have purchased it. And again, this is not constructing this equipment, so we do not capitalize interest in this case. We're just buying the equipment and starting to use it. Interest costs after we start using the equipment get recorded as expenses. Okay, so we just record the cash and the note payable and plug the two to equipment. The third one is that we actually have a discount. So the cost is $20,000. If we pay early, we'll get a discount. And they created some sort of purchase discount credit account. I don't know how they manage that, but we know that, if we get a discounts reduce our cost, right? If we didn't take advantage of the discount, the cost is $20,000. But if we take advantage of the 2% discount, which is $400, that $400 should reduce our cost. So discounts reduce cost. And so we can see here that instead of $20,000, the real cost of the equipment is $19,600. And the fourth one, we received land that was donated to us. They didn't record it, but it is an asset for us, so we want to record the land, and we're going to record it at its fair value and record the revenue coming in. And then the last one, we have a warehouse that we paid $600,000 for, but it could have purchased the building, another building for $740,000. So it's really kind of weird, isn't it, that they recorded the building at $740,000 and they show some sort of profit on that purchase. How weird is that? So we want to record our costs, not what our cost would have been if we bought a different building. So our cost for this building is $600,000, and that's what we want to record it at.